Welcome back to Chain Finance. Today, we're diving into a fascinating topic. Not charts, not technical analysis, but the psychology behind crypto investing. Why do people take huge risks in crypto? What makes them buy meme coins at the top? Why do they hold losing tokens for too long? And what drives this risky behavior? Let's explore the hidden psychology and uncover why investors act the way they do. The first big factor is FOMO, fear of missing out. When people see Bitcoin pumping or a meme coin trending online, they jump in late, hoping not to miss profits. But often, they buy at the top and end up holding bags. This cycle repeats again and again. The second factor is greed. Greed makes investors dream of overnight wealth. Stories of early Shiba Inu or Dogecoin holders make people believe they could be next. They imagine turning $100 into $100,000 and take extreme risks chasing that dream. The third factor is loss aversion. People hate losing money more than they love winning. So when prices drop, they don't sell. They hold on, hoping it will bounce back. This often leads to deeper losses. But psychology stops them from cutting losses early. The fourth factor is herd mentality. Investors follow what everyone else is doing. If Twitter says a coin will moon, or a big influencer tweets about it, thousands buy without research. It feels safer to move with the crowd. But often, the crowd is wrong. The fifth factor is overconfidence. Many traders believe they are smarter than the market. They think they've found the next hidden gem, or that they can time the market perfectly. This confidence pushes them into risky trades, and when it fails, reality hits hard. The sixth factor is gambling behavior. For some, crypto is like a casino. The thrill of buying and watching prices move feels like betting on roulette. The dopamine rush is addictive, and this keeps investors chasing risky plays. Another powerful force is confirmation bias. People only seek information that supports their belief. If they believe a coin will go up, they ignore all the red flags. They follow bullish news, ignore warnings, and risk everything based on one-sided info. Then comes survivorship bias. Investors hear about the success stories, the millionaire who bought Bitcoin early, the trader who made millions on Solana, but they don't hear about the millions who lost. This creates a false picture of reality. It makes risky bets feel justified. Let's not forget social pressure. Friends and family talk about crypto wins. Group chats are full of hype. Nobody wants to be the one left behind, so they invest out of pressure, not logic. Another big driver is the illusion of control. People think they control the outcome by watching charts all day, by timing buys and sells. But in reality, the market is unpredictable, and no one has full control. Then comes recency bias. If Bitcoin just pumped, people assume it will keep going. If a coin just crashed, they assume it's dead forever. Recent events shape investor behavior, even if history tells a different story. We also see anchor bias. Investors anchor their expectations to one price. If Bitcoin was $60,000 once, they believe it will surely return there. Anchoring blinds them to current realities. The psychology of hope plays a huge role. People buy coins and hope for life-changing gains. Hope makes them hold risky tokens, even when logic says to exit. But the truth is simple. Crypto psychology is powerful, and it often leads investors into risky choices. FOMO, greed, overconfidence, and hope. They are all part of the game. The key is awareness. When you understand these psychological traps, you can control them. You can make smarter, safer choices, and avoid becoming another statistic. Crypto psychology explains why risk feels so tempting, but awareness can turn that risk into smarter strategy.